similar to last week, but I think we should be able to get through the content within the allotted time. But of course, we'll always pause for questions that may come up during this presentation. So just give me 1 second as I go ahead and pull this up. All right, so we're gonna just go into presentation mode. And second here, right, look at my display settings. All right, so once again, module 8, managing debt, is the topic today. This is the fourth presentation we've been able to do thus far. I guess we've got 2 more to go within the upcoming weeks. So I'll get right into it. So just kind of looking at it overall, like every other presentation we've provided, there's a participant guide that should have been sent out to you. And with that being said, the pre-training survey will be on page 49 of your participant guide with the questions that are listed below, true, false answers, for you to provide your responses. But we'll get right into it for section 1, which is basically, the question we're going to ask is, what is debt? And you'll be able to see this on page 4 in your participant guide. So like every other presentation we've done, each section will have a key takeaway that we'll kind of lead with as we introduce the topic, and then we'll kind of circle back at the end of the particular section. So the section 1, our key takeaway today is just understanding your debt is the first step to managing it, right? So that's going to be kind of what we're going to highlight for section 1. And then when we think about debt and credit, essentially the question that comes up, what is the difference between credit and debt? And we'll kind of go into this, okay? So debt is not the same as credit. Debt is the money you owe. Credit is the ability to borrow money. And then, of course, you can use credit to borrow money, which then essentially becomes debt. We'll kind of go into the next topic, the next part of the section 1, which is debtors and creditors. And of course, the question that will come up, what is the difference between a creditor and a debtor? So essentially, debtors owe money to creditors or lenders. Debtors owe money, they owe money, they borrowed it. Creditors and lenders loan the money. And then, of course, understanding your debt is you need to know who you owe, how much you owe them, how much the payments are, when the payments are due, and any other important facts about your debts. With that being said, people get into debt for so many different reasons, right? And the picture that you're going to see right now on your screen is just an illustration of some of the things that people may find themselves debt in. So we'll kind of go through this. So, hey, one, at the top could be, essentially purchasing assets, paying bills or as a result of not paying them, covering unexpected expenses or emergencies. This was kind of discussed in some of the previous presentations we had done. And then, of course, buying something they want or need, right? Essentially, kind of remember we discussed needs and wants. Essentially, if it's going to put you in a financial situation where you don't have the money to pay for it, even if you're putting it on a credit card, you're essentially basically borrowing and buying something you need. So it's just really, really kind of important to realize it. But these are just some of the key reasons that people could find themselves, falling into debt. And the question we'll have to ask ourselves is how debt can affect your financial situation, right? So when we think about it, you need to use future income to pay off your debts, also called obligating future income. Generally, in most instances, you're paying interest and sometimes fees on your debt that's, until it's paid off. And even essentially, like I was saying in some of the presentations, somebody puts, an amount on a credit card, that balance is not cleared in full at the end of that, within the 25 days, period. There's a balance that's due, there's interest that's being charged. And the longer that debt, the longer you take to pay off the debt, essentially, that debt just keeps accruing interest. And when you kind of put it in perspective, in a lot of instances, you'll find people paying, hundreds, if not more, in interest over a 2, 4, 5-year period, most lenders now would kind of basically, propose like a grace period where, hey, if you pay this off in 6 months, there's no interest. If you pay this off in a year, there's no interest, which is really good. The goal is to try to make sure that if you do find yourself in that situation, try to pay that debt off as soon as possible, because those additional fees and interest will definitely add up. And of course, in addition to that, how can debt, impact your financial situation, just in terms of you being able to achieve your goals. If there's a long-term, short-term or long-term, goal to basically purchase a home or anything else, kind of your debt to income ratio, something that we've kind of spoken about, in the past, credit, lenders are going to look at things like that. So if it almost seems like your income to debt ratio is not in a very healthy position, that could essentially affect your financial situation and, limit you from achieving or, the goals that you may have set for yourself. So, when we think about it, this is going to be one of the, exercises, apply it, understanding my debt. So you'll be able to see this in page 6 of your participant guide. And it's just kind of gathering information on your debts, completing the table and answering the respective questions. So as we conclude section 1, remember the key takeaway: understanding your debt is the first step to managing it. So now we'll move on to section 2, and we'll kind of talk about how debt works. And this will be on page 8 in your participant guide. So for section 2 key takeaways, consider how debt works so you can be informed about the decisions that you're going to be making related to it. So right now I'm going to go through a couple of slides that are going to kind of show some example, like what we'll essentially look at as debt lingo. I think there's about 7 different ones that are going to be outlined. Feel free to kind of follow along and even possibly, look at answering the questions that, basically choosing the correct answer that will come up on the screen shortly. So a loan with collateral that the lender can take if the loan is not repaid according to the loan agreement is, I guess, what kind of loan? Principal, secured, or annual percentage rate, right? So just kind of, if you're looking at it, select your answer. I kind of know what the answer is. It's something we can kind of always revisit at a later time, but here's going to be kind of the first question to kind of think about it. Loan with collateral that a lender can take if the loan is not repaid according to the loan agreement. So just kind of pick your answer right there. For debt lingo, question number 2, how much money you borrow? What is this? Is this principal? Is this interest? Or is this fees? Which one of these is going to be the correct answer? Go ahead and select yours. Debt lingo number 3, the main cost of borrowing money, right? So essentially, is it current balance, interest, or credit? Which one of these is going to be associated with the cost of borrowing money? Go ahead and select your answer for this one. Debt lingo, a credit agreement that allows you to borrow money from time to time up to a pre-approved maximum credit line. What is this? Is this an installment loan, revolving credit, or a lease agreement? Which one is it? Go ahead and select your answer for question number 4. Debt lingo number 5, question number 5, the total cost of credit on a yearly basis. What is this? Is this annual fees? Is this also an annual adjustment, or is this the annual percentage rate? What is the total cost on a yearly basis? Debt lingo number 6, when you borrow a specific amount of money and repay it over a set period of time, what does this actually entail? Revolving credit, principal, or an installment loan? Which one is it? Debt lingo number 7, a loan with no collateral is defined as what? A secured loan, an unsecured loan, or a mortgage, right? So those are just kind of, 7 just quick questions for you to kind of look at and consider. And I'm sure, if we need to revisit this at the end of the presentation, I'll be more than happy to do that. But, for the most part, answers will give you an option to choose between A, B, and C. So we'll go into the topic around installment loans. When we think about installment loans, let's talk about principal. So principal is the amount that you borrow, right? The term is how long you have to repay the principal and pay interest. You generally pay the same amount every payment unless there's a variable adjustable interest rate. So if the interest rates, like I'm sure we've all witnessed over the last year, the federal government the Fed has continued to raise interest rates, as a way of tempering down inflation, right? So interest rates, essentially, depending if it's not a fixed rate and it's variable, that means whatever balance you have outstanding could essentially mean that the interest that you're earning on that loan, could go up. And of course, essentially the time to pay it off could take longer. So it's just always important to remember that in most instances, hey, that you can be paying the same amount every month on an installment loan, but if there's a variable interest that's, kind of determined by, where the market rate determines it, then of course those payments may vary. When we think about revolving credit, right? So, essentially you can borrow, when we think about credit, the most you can borrow, payment, is based on the credit you have used. The minimum payment is often 1 to 5% of the outstanding balance, right? And the goal, of course, is to always pay more, pay off sooner to pay less interest. So you can borrow up to the credit limit, right? The limit is often based on your credit scores. The payment is based on the amount of the credit limit you've used. And of course, you build monthly, you build a monthly minimum, which is anywhere from 1 to 5%. So just really, really important to kind of remember that. But the sooner you pay that off, the less interest you will pay on a revolving credit balance. For our next participant guide, you'll be able to see this on page 9. It's how installment loans work. So basically, just go ahead and read the scenario and answer the questions using the sample amortization table on the next page. So the scenario is actually listed out there. You can go through this and then kind of just, review it. And then, of course, you'll be able to, the next participant guide we'll be able to show is on page 11, which talks about how revolving credit works. Similar thing, there's a scenario where Zoe learns about revolving credit, kind of, read through it, and of course, use the tables, to answer the questions after the table. We're going to move ahead and talk about fees. So when we think about fees, right, these are additional charges. They are not interest. Right. And it's very, very important to make sure we understand, it's important you understand the fees you'll be charged and the fees you may be charged, right? Because fees are those things where if it's a late payment, we're giving you a late payment fee. If you go over the credit limit, we're giving you an over limit fee, right? So it's really, really important to kind of think about it, especially when we think about revolving credit card, if there's any fees that are going to be added, being knowledgeable on what those are will really put you in, in a better financial position and kind of avoid the additional $35 or whatever case, might be in terms of that, that credit card companies, may be charging. So those fees can generally come up, and if we don't meet the terms and conditions and obligation of the debt, then there's additional fees that you may be charged. Most importantly, fees are not part of the interest. It's a separate, charge that you're going to have to cover. When we think about prepayment, right, let's talk about early prepayment of all or part of a loan. First and foremost, it reduces the interest costs and may mean an earlier pay of debt. And then, of course, it's the one thing we always want to ask is if there's any fees, for repayment, like any penalties for paying it off earlier. But essentially, any loan that you have out there, if you had to reach out to the lender and say to them, hey, I'm looking at a payoff date of, maybe I'll just kind of throw out a number, the 28th of February. If I pay this off, if I choose to pay this entire balance off, what is going to be my total payoff cost, right? And they'll be able to calculate that, because with every loan that's out there, even though the interest may be accruing and showing up on the statement on a monthly basis, that interest is accruing, day by day. So whether it's over, a 30-day period, really, really important to kind of know, hey, if I'm paying it off this week versus, next week, what does that difference look like? And it's always important to ask if there's any penalties, for prepayment. Like if I pay this off, am I gonna have to face any additional charges? So as we come to the end of section 2, remember the key takeaway for this particular section is consider how debt works so you can make informed decisions about it. All right, so we're going to move over to section 3, which talks about reducing debt. And you'll be able to see this on page 14 in your participant guide. So to kick off section 3, we're going to highlight the key takeaway. So the goal is to develop a plan to reduce your debt and get help if needed, such as from a trained credit counselor. So we're going to talk about the 2 strategies for reducing debt. First and foremost, we'll talk about the high cost debt first method, and then we'll talk about the snowball method. And as you can see, the scales are balanced here. So essentially, you'd have to kind of decide which method you want to go with. But with that being said, the high cost debt method means you first pay off the debt with the highest cost to you. And the snowball method means you first pay off the debt with the lowest balance, right? So think about the highest cost, interest, lowest balance, snowball method. Page 15 of your participant guide is a plan on how to reduce your debt, right? So with that being said, the high cost first debt method is what we're going to talk about. And when we think about it, here's one of the advantages that we're going to cover. First and foremost, it saves you money. High cost debt method. Disadvantage is that progress may seem slower. So essentially what you need to do, just as kind of a best practice, is kind of list your debt, the highest cost to you to the lowest, right? Pay the amount on each debt, make an extra payment to the first debt on the list. And after you pay off the first debt, make an extra payment on the next debt of the list and continue as needed. So the high cost method, most people look at this as definitely being the one that can put you on a path to kind of reducing those additional costs, paying it down. And as you kind of gain that momentum, and you continue as needed, then you'll be able to kind of take care of the next, highest cost debt to you. The snowball method, the advantage is it kind of makes it seem like the progress, you're definitely moving faster. The only, disadvantage is that you may pay more money. So if you had to think about the snowball method, you list the debts lowest balance to the highest. You pay the amount on each debt. You make an extra payment to the first debt on the list. After you pay off the first debt, you then make an extra payment on the next debt on the list. And then, of course, you continue as needed. So high cost debt method, snowball debt method. I'm going to kind of break this down, further on in the presentation. Page 19 in your participant guide is basically making a plan to reduce your debt. Like, most of the other participant guides that we've listed, it's kind of, look at the scenario, with the table listing, read the scenario, and then, of course, answer the questions. So now let's kind of do a deep dive into the high cost debt method worksheet and answer key. So when we think about the high cost debt method, right? So here's the order. We're going to list the 3 debts. Credit card company. Number 2 is hospital and medical debt. Number 3 is a bank loan, right? $8,000 owed on that credit card. $10,000 owed on the hospital debt. And $2,000 owed on the car loan, right? But look at the interest rates. The interest rate essentially is 14% on your credit card, 10% on the hospital bill, and 6% on the bank loan, right? So this is kind of listing it down, and these are ranked not in order of the amounts, but in order of the interest rate highest to lowest, because wherever the higher the interest rate is, chances are, depending on the, on the period of time, that essentially will result in a, higher cost to you. Now, when we look at the snowball method worksheet, reversed order, right? So in this instance, they're saying, okay, hey, we owe $2,000 for the bank loan. We got $8,000 on the credit card and $10,000 on the hospital debt. Now, if you remember in the previous worksheet, the last 2 is where you have, the second one that's listed is where you have the highest interest rate, followed by the hospital debt. So the snowball method might seem like, oh man, guess what? I just paid off, my car loan, the amount I owed was $2,000. But as you're paying that off, these other two amounts still accruing that interest, right? So essentially, whether you are looking at adding more money, to the car loan at the expense of, either putting more money into into your credit card company or the hospital debt, it's going to take you longer to settle the two debts, the debts that are listed in payoff order 2 and 3. So so the cost is, while the advantage might seem like, hey, I paid this off and I'm on to the next one, the timelines and depending on what, goal you've set for yourself to pay this off, you could end up accruing additional interest combined for that $18,000, that $8,000 and that $10,000 debt. If you remember, the car loan was only sitting at 6%. So essentially, think about it ultimately, this is something that I've actually done, personally as well. Various credit card companies, not with most credit card companies, any card that you've opened in the last 2 years, interest rates, are going to definitely be up there. And of course, now they've raised them. So what I typically tend to look at is, okay, what are the balances? What's the interest rate? And which one do I want to kind of, which one's going to cost me more money to have? Which card in my wallet is costing me more money, in the long run? And of course, you basically just try to increase your payments to that particular account, because as you continue to bring that balance down, the interest that's accruing is not going to be as high as paying the minimum there and then kind of going to pay off another account that might have a lower interest rate. Where can we get help, with related to, with issues related to our debt? Well, first and foremost, as mentioned in previous sessions, there's nonprofit, credit counseling organizations. You can actually go to USA.gov and search for credit counseling, and of course, obtain tips from the Federal Trade Commission on how to choose and find, a credit counselor. One thing we want to do is make sure we choose carefully, right? Debt settlement companies, they offer to make deals with your creditors. Always important to ask about the fees in the process. And when we think about debt consolidation loans, one loan used to pay off multiple debts might sound like a great deal. Like, like in the past, I remember I used to use, I've had Credit Karma, and, you kind of get these emails or you get these alerts that come up on Credit Karma and say, hey, you can consolidate all your debt into one payment, and essentially you're doing that, but you're taking out a loan. Always kind of, weigh what the interest rate are and what the fees are, because while it might seem like, hey, I'm bringing everything into one payment, I don't have to make multiple payments. Essentially, most of these debt consolidation loans will generally tend to come with some additional fees and other costs. The best thing that you can do is make sure that you're knowledgeable on what you're getting yourself into, especially should you consider that as an option. Page 22 in our participant guide, what to watch out for when getting help with your debt. There's a checklist that you can use to identify some of the items to watch out for, when you get help managing your debt. And they can be a good reminder to ask more questions, check the items you need to ask about. So as we conclude section 3, just remember the key takeaway. Develop a plan to reduce your debt and get help if needed, such as from a trained counselor. Just 1 second. Sorry, all right, so we're going to move on to section 4, non-payment of debts and debts in collection. And this will be on page 24 in your participant guide. So section 4, our key takeaway to kick off this section is don't ignore a debt collector. Make sure any debt that you are asked to pay is valid, right, and paid off as soon as possible, and get help if you need it. So what we're going to talk about now is kind of the life cycle of debt. So let's talk about let's look at a current situation. So first and foremost, you take on the debt, you pay on time as agreed, equals current, debt's paid off, no issues, right? Then we talk about the life cycle of a debt that's not current, right? So you take on the debt, we miss payments, the account becomes delinquent, then the account is sent into default, then it's charged off, then it's collections, and then assigned or sold to a debt collector. I think we kind of spoke about this in our previous presentation. So the best thing that you can do is just try to stay current on any debt that you have. Any delinquencies, whether it's 30, 60, 90, or 120 days, will be reported to the credit bureaus, respectively. When you're in default, and even if you go into a charge-off, all of that will be reflected, as part of the credit history. And then once collections gets, a hold of it, essentially they taking on that debt, their goal is to recover as much of that, debt that you owe as possible. And once, that gets added to the credit report, remember like what we spoke about last week, then that could potentially just bring your credit scores down further until that debt is paid off. So we think about not paying our debts. The question is, what can happen if you don't pay your debts on time and as agreed? Several things can happen if you don't pay your debts. Late fees and more money in interest. Those, calls by the debt collectors, blowing your phone up, and just constantly, putting it in almost things like it's on auto dial where they just keep calling you multiple times throughout the day. You could essentially lose services or pay costs to reestablish them. If you think about like a cable company or, even utilities, hey, if you haven't paid it off and there's an accruing balance, it could be a reconnection fee that they charge you, which means now, that's going to end up costing you more money, and essentially you're losing collateral, so that's really, really, critical as well. What else can happen? Negative entries on your credit reports, drop in scores, lawsuits from creditors. Depending on how far they want to take it, you could find yourself in a situation where you've got wage garnishment, account garnishment, and treasury offset, right? So with treasury offset, really, really important, if there's any money that's owed in some way, shape, or form, a student loan, anything that the federal government has an opportunity or has the ability to go in and get their money. So think about it, maybe you file your federal tax returns, you're getting a refund, but there's this outstanding debt, right? And essentially it could be tied, I'm just going to use this example, like maybe, a student loan or something of that sort. Essentially, if they want to go ahead, Department of Education, they have the ability to have the Treasury Department pull that money and settle that debt, which means now, Treasury offset is, you're kind of looking at local government, federal government, to where, hey, if there's, money that's outstanding and you're due a refund or there's money coming to you, through the state or through the federal government, they'll be able to basically go ahead and recoup their money there. So those are just some of the things that you can also do to avoid. Page 26 in your participant guide is kind of dealing with, with debts that if you find yourself and you've got debts in collection, if you have any debts in collection, you can use the checklist to make sure you are paying what you actually owe. And of course, sending payment only to someone who can legitimately collect the debt as, shown in the guide that you'll be able to review. Before making a plan to pay a debt, always be sure to know you owe the debt, the statute of limitations hasn't expired, you're dealing with a legitimate debt collector and not somebody that's trying to scam you. And if you know these, three items, and then then you can basically go ahead and pay the debt in full if possible. If you've been able to establish all three, then by all means, go ahead and settle that. If payment in full is not possible, make sure you always set up a payment plan you can afford. Negotiate a lower balance, right? Ask for paid in full and not settled, right? Because remember, we spoke about this. If it's paid in full, they'll be able to reflect that. Hey, can you basically have this removed from my credit report once I've settled this account? Makes it seem like it never existed. Those are just the options. So, payment plans, whether it's monthly payments or anything else related to it, really, really important to kind of have that something that you can actually afford. Don't agree to something that you might might put you in a further financial strain situation. So whatever that monthly payment looks like, setting it up on auto pay, whether or kind of just paying it through a checking account, all those things are definitely possible. You just want to make sure that it's something that you're in total that you're able to afford. Debt collectors must follow the following rules, right? So first and foremost, no abusive, unfair, or deceptive practices. So no inconvenient times or places, no calls at work if told not to call, no threats of violence, no obscene or profane language. And of course, report problems. If there's any problems that you have with the debt collector, you can always report those, right? But some of them may be calling you at work, maybe they've got at work at hold of her. You have the right to tell them, hey, this is my place of employment. I would prefer that you not call me at this number, between the hours of 9 and 5, and they can't do it because that's something that you request them not to do. And of course, for Section 4, just remember our key takeaway: don't ignore a debt collector. Make sure any debt you are asked to pay is valued as soon as possible, and get help if you need it. Section 5, we're going to be talking about dealing with student loan debt, and you'll be able to see this in page 30 of your participant guide. So the key takeaway here is going to be, when it's time to pay back your student loans, consider your options and understand what will happen if you're late with payments. Your loan servicer can help you explore repayment plans. Student loan debt, money owed on student loans. This is the biggest debt that some people will ever have, and it can be a stressful topic at times, right? And what can happen if I don't repay my student loans? Well, first and foremost, depending on when those loans come due, depending on what kind of loans you actually took out, you'll be paying more fees and interest. They have the ability to, impose wage garnishment, account garnishment, as well as treasury offset. That's something that, through the Department of Education and, wherever the service of the loan is, they have that ability to enact these 4 items that are listed, the 4 points that are listed. What else can happen if the student loan debt is not paid? You'll be unable to get more more federal student aid, may need to take 1 or more semesters off, so which means kind of disruption, especially if you're working towards, attaining a higher education. Just kind of staying current with your student loans would definitely put you in a position to be able to get more federal student aid. Negative entries on the credit reports, right? Which then, of course, results in a decrease in your credit scores, decreased ability to borrow money. And then, of course, there's always the stress of owing the money, which could then potentially delay you in reaching some of your other financial goals. Page 31 in our participant guide, right? My student loan debt. You can use the checklist to explore how student loan debt may be affecting you. So that's just some of the questions that are listed on page 31. We'll talk about the types of student loans. So we have this private student loans and federal student loans. For the sake of this presentation, we will not be discussing private student loans, but we will be able to kind of talk about the federal student loan repayment options. So we think about federal student loan repayment options, we talk about grace periods, we talk about standard repayment plan, default, restructured payments not based on income, so graduated repayment plan and extended repayment plan. This is all the different repayment plans that, that can be made available to you. You can also get repayment plans based on income, which is revised pay as you earn, repay, pay as you earn as pay, and then of course an income-based repayment plan, and an income contingent repayment plan, which is an ICR. So these are all the different options that we can look at, or that you can request to get information on related to settling that student loan debt, federal student loan debt. Forbearance and deferment, right? Essentially with forbearance, it's a temporary, what does this amount to? It's a temporary postponement, reduction of payments due to financial difficulty. Hey, graduated, maybe the job that you've actually got is not bringing in as much income as you were, that you were anticipating. Hey, kind of just, meeting your day-to-day or month-to-month financial obligations. might be a bit of a challenge. Got the student loan debt now that's come due. Hey, you know what? I'm just going to quit. I'm just going to request a forbearance, which is just a temporary postponement or the reduction of payments due to financial difficulty. Then we also talk about deferment, which is temporary suspension of loan payments for specific situations. Do you qualify for forbearance or do you qualify for deferment? Wherever you're dealing with, wherever the loan servicer is, those are the questions you can ask. And of course, based on the situation that you'd be outlining to them, they'd be able to kind of figure out what the best solution is going to be to bring, to have that student loan paid off. Loan forgiveness and cancellation, right? Cancellation and discharge. So maybe a closed school discharge, public service loan forgiveness, teacher loan forgiveness. There's also the option to get a total and permanent disability discharge. And then, of course, discharge due to death. So these are the options to kind of look at when we talk about loan forgiveness, cancellation, or discharge, something that can, be also brought up with the lender, and options that can be explored on your end to have that student loan taken care of. Right, the most important thing we can do is always take action to prevent default. To prevent default, a different payment due date. Here's some of the options: a different repayment plan option. As mentioned, forbearance, deferment, loan forgiveness, loan cancellation, and loan discharge. If somebody decides to file for bankruptcy, it's important to remember that a bankruptcy does not automatically discharge federal student loans, right? So that's also something to kind of consider and kind of think about. Hey, if you file for bankruptcy and maybe you've got $10,000, $20,000, $15,000 in student loan debt, you may still be, obligated to repay that. Might not be, part and parcel of the bankruptcy that you've filed. One thing we want to do is, beware of student loan scams. Never pay, an upfront fee. As mentioned in previous presentation, only scammers promise fast loan forgiveness. And a Department of Education seal doesn't mean it's legitimate. And last but not least, you never want to share your federal student aid identification number with anybody that you're dealing with that's not reputable. They might send you a text message, they might send you an email, they might call you and kind of want to go through all these different options. And hey, just to get you started, hey, we'd be more than happy to, accept a payment today of $135, and this will kind of show good faith on your part. Always be careful of those, kind of calls and scammers. In most instances, the person, wherever you may have bought, got the loan through initially, federal student loans, essentially can change ownership on the back end. The best thing that you can do is always make sure that who the current service of that loan is, login information, maybe even just setting up, an account to where you can be able to monitor that. And of course, most importantly, if you've got any payment plans set up, that as those payments are going through, those balances are decreasing as well. If it's in deferment, if it's in forbearance, what does the timeline look like? But the most important thing you want to do is protect yourself and, and make sure you're not falling prey to any scams. Page 34 in our participant guide will be exploring options for repaying your student loans, right? So there's a scenario that's kind of given. Here, you can go ahead and review that and answer the questions. And then, of course, on page 35 in our participant guide is, hey, if you're behind on your student loans checklist, if you're behind on payments or in default, there's several steps you can take. You can use a checklist to kind of track the steps towards resolving your student loan debt. If you need more information, to move these steps forward, you can always contact the financial aid office of the school you attended, or contact the lender or the loan servicer. For federal student loans, you can look up the loan information in the National Student Loan Data System, and the URL is provided. Section 5, remember key takeaway. When it's time to pay back your student loans, consider your options and understand what will happen if you're late with payments. Your loan servicer can help you explore the repayment plans. Section 6, managing medical debt, which will be found on page 37 in your participant guide. To kick off our section, like every other section we've covered, Key takeaways: if you receive a medical bill, make sure it's valid. If you can't afford to pay it, set up a payment plan. And we'll ask the question, what is medical debt? Medical debt is essentially the result of not paying medical bills when they're due. You don't start out with debt when you receive medical care, right? So you get the care, you receive medical care, you receive the bill for the medical care. The medical bill not paid becomes medical debt. If you remember last time, we actually looked at this in the previous presentation, we talked about that 180 days before this actually even will show up on your credit report. So it's really, really important that, to try to get some sort of arrangement set up within the 6 months before it can, definitely have an additional negative impact, including on credit reports. Why do medical bills often turn into medical debt? Well, of course, first and foremost, life happens, right? Those emergencies come up, so it's often unplanned. Total costs not known up front, depending on what insurance covers, what the additional expenses are, all these things can add up very, very quickly. And, it can be confusing. Many individuals providing care, lack of understandable detail, insurance information, often unknown. What is my deductible? What is my out-of-pocket cost? How much is insurance paying? What do I have to put down, on my end? What do I have to come up with? Essentially when the medical care and all that stuff is being provided, when you've received the care, now, depending on, which medical office you're dealing with or which hospital you're dealing with, they've got a billing department. They'll send it off to the insurance company. The insurance company will say, hey, we're only covering this amount. And then you get a bill and say, hey, insurance is only agreeing to pay, 80% of this bill. You're still on hook for the 20% cut, for the 20% that's remaining. And then, of course, at that point, they give you a timeline to pay it off. But always make sure that, you're fully aware of what it is. And these are the primary reasons as to how a medical bill can turn into medical debt. With that being said, we want to take action on our medical debt. So page 38 of your participant guide. If you have medical debt, consider the following steps. The situation kind of as outlined. And then, of course, you can just follow, through on the actual steps that are provided within the participant guide. Possible actions that you can do to make sure it's a bill and you owe it. If you don't owe the bill, dispute the bill. If you do owe it but can't pay it in full, medical bill, try to negotiate a lower payment amount, try to reset up a payment plan, try to settle the debt, work with a nonprofit, credit counseling organization. And here it says, consider bankruptcy. I guess in that situation, that could be an insurmountable debt. But the options we should always look at is lower payments, repayment plans, and what does this look like over 6, 12, 18, 24 months, right? The goal is to settle the debt. And, it's kind of just expressing that, hey, I understand that this is a bill that I owe you. However, this is what my current financial situation looks like. This is how much I can afford to pay you over the next 6 months, the next 12 months. Let's kind of come to an agreement. Then, of course, once they do agree on your repayment plan, always make sure you get that stuff in writing, whether it's email communicate, confirmation, whatever the case might be. And then, of course, you just want to make sure if there's a repayment plan that's in place that you fully meet the obligations of that repayment plan and not fall behind. Because in some instances, if you do fall behind on a repayment plan and you miss a payment, that entire repayment plan could be null and void. And then after that, they're coming back for the full amount. So, it's just to make sure that, you are fully aware of what, it's going to take and how much time you have to settle that debt. Medical debt and collections and credit. Unpaid medical bills appear on credit reports 180 days after missed, as previously mentioned in our previous presentations. Debts can still be referred to collections. And of course, for credit scores, treatment of medical debt varies, right? So how much of an impact is it going to have? What does this look like? Which credit collection agency has picked this up and kind of what are they reporting? So, these are just kind of some of the things to consider. But ultimately, and everybody's financial situation will vary. But as mentioned in our previous presentation, the one thing you want to do is try to get some sort of plan in place within the first 180 days. Page 41 in our participant guide, what to do about medical debt. right? So you'll read the scenario and answer the question to figure out what Luther could do about his medical debt, what steps Luther can take to reduce that, the chance that these medical bills will go into a debt collection. It will go to a debt collection agency. If we can avoid that, then we're putting ourselves in a good place. Section 6 is just to remember key takeaway. If you receive a medical bill, make sure it's valid. If you can't afford to pay, try to set up a repayment plan, right? So that kind of concludes section 6 as we move over to section number 7. And just a quick time check, it is 6:47 on my watch. So we're going to go through section 7, understanding high cost debt, which will be on page 42 in your participant guide. So section 7, key takeaway. Understand how high cost debt works and identify lower cost options for the future. So what is high cost debt? The result of a small dollar short-term loans with costly fees or high interest rates or both. They are risks and benefits of all financial products and services, including high cost debt. So let's talk about some of these high cost debt loans. So essentially you got a car or vehicle title loans. Loan for a small amount of money for a short time. Your vehicle title is the collateral. Single payment, payment loans often due in 30 days and can be very expensive, to say the least. And then of course you get those payday or payday advance loans. Those, I have to say, there's all these different places throughout all the different neighborhoods and cities. Essentially people are going in, to pay the advance, hey, I'm gonna borrow $200 until my next paycheck, right? And of course everybody's financial situation is different, but the interest you're paying, on that $200 amount, and then essentially in 2 weeks' time, you have to go ahead and basically pay it off plus interest. Always something to definitely consider. But when we think about it, the borrower first, the borrower visits the pay lender in person or online to get a loan, or the borrower reborrows a prior loan, right? The borrower gives the lender a personal check dated for 14 to 30 days, in the future, which gives permission for an automatic withdrawal from the account. Lender gives their borrower the amount of the loan. When the loan is due, if the borrower doesn't have the money to cover the check or withdrawal loan, withdrawal, right, the loan may be reborrowed with more fees. So what you end up finding happening here in most instances, depending on what the interest rate looks like, right? And as I said, everyone's situation is going to be different. It becomes a cycle, and that's kind of illustrated here. So if you can't repay it within 14 days, now you're pushing to 30. If you can't get it through 30, now whatever the original amount that you borrowed, you're gonna have to reborrow that money plus pay it off. So in most instances, here's what happens. I'm just kind of, give you guys a scenario. You borrow the $200, and maybe you have to pay back, I'm just going to say $250, all right, $250 back. You get to that 14-day time frame. You wrote a post-dated check for them to cover it. You decide you're going to go in and repay the loan, but as you repay it, you reborrow. So all you did was you repaid it off. They earned the $50, whatever amount is in interest. Now you're reborrowing, and guess what? You're going to go through that same situation unless you can cover it and step away from it. Payday advance loans. There's a lot of, when you think about it, essentially everyone's, there's emergencies and people may not have the cash on hand or the savings, but these type of loans definitely in some instances put people at a disadvantage, because if you can't get out of that cycle, then essentially, even if you did repay this off, say at the end of the second month, and now you finally able to push it, for every 14 days, you're basically paying interest on the money that you're borrowing. And then if you're reborrowing it, and if there's fees associated with it, when you look at it overall, a lot of people find themselves having paid a lot more money. A $200 loan, payday loan ends up costing them, $300-400 if they can't, pay it off, and of course end up incurring, the interest that's on there, and of course any other fees. Pawn shop loans, the item you pawn is a collateral. The loan amount is usually 25 to 50% of how much you pawn shop considers the item to be worth. So then again, you have somebody saying, yeah, this is worth, $1,000 or $2,000, right? You repay the loan, you renew it, or you lose it. That's basically what it is. Whatever item you've put out there to have, if you can't repay it back, chances are then that item, will become, property of that pawn shop. Page 44 in our participant guide, exploring alternatives to high cost debt. In this instance, we're reading the scenario and answering the questions to explore Jamila's alternatives to a high cost debt. What are Jamila's alternatives for covering the electricity bill, right? And you can definitely provide those answers in the participant guide. Page 45 of our participant guide will basically look at my alternatives to high cost debt, right? So you can use the checklist to identify alternatives to high cost debt that could work for you, right? So what are the short-term alternatives, right? Kind of listed there in terms of it. So it'll give you a checklist and you can kind of figure out, what you can do to kind of cover that high cost debt based on the options that are provided. Section 7, remember our key takeaway, understanding how high cost debt works, identifying low cost options to ensure that you don't find yourself in a cycle to where you're paying additional fees and additional interest on a small amount that you may have borrowed, and just kind of understanding is by 14, 30 days. What are the terms and condition of it? And whatever you're using as collateral, what does this mean in terms if you can't pay it back? So when we think about it as we come to the end of our presentation, take action. This will be in page 46 of your participant guide. So here's the questions. What will I do? How will I do it? Will I share my plans with anyone? If so, who? And always remember, you can visit fdic.gov and education to learn more on managing your debt. There's a post-training survey that will be provided on page 51 of your participant guide. And of course, we'll just be answering the questions that are provided, based on what we've covered today, true, false answers, and then of course, multiple choice answers that'll be provided. I want to take this time to thank you for allowing me to go through this presentation, quite a few slides, to cover. So right now, I'll go ahead and stop sharing my screen and, answer any questions that you may have.
I don't see any questions in the chat. I just saw a hand thanking you for the presentation. It was a lot of material to cover. Are there any specific questions? No questions? Not about that. I know I'm a little embarrassed. I am old, as you can tell by my gray hair, and I am still trying to get rid of my student loan debt. So I was paying very close attention to that section. So,
yeah, I think there's a lot of us that find ourselves in that situation with student loan debt. I can, I'll be more than, I can say that I've had to early on kind of look at a forbearance, deferments, because hey, you get the education, but you pay for it. School is definitely not cheap,
Absolutely. All right, great. Well, since there are no specific questions about the material covered, as we can end for the night, so we can review and completely receive everything that you have shared with us this evening. So thank you so much, Jermaine. And ladies, we'll see you next Wednesday. Astrid?
Yes, I did have one other question. For the debt collection, you said settled versus paid in full. What's the difference? Like if you pay it in full, if you settle it, I'm assuming that's for a lower rate, but do they still have the same option of being able to remove it if it's like settle for a lesser amount? Yeah,
if it's settled for a lesser amount, it could still negatively impact your credit score. If you just say, hey, report this as paid in full, because settlements typically don't work. I mean, even though they'll be like, hey, you owe $500. We're willing to go ahead and settle this for $290. So it almost seems like they give you a discount. But when they report it to the credit bureaus, it'll say settlement. And that actually does have a negative impact on your overall credit score. It will. So actually looking to settle, paid in full, or if you're saying, hey, I'm going to go ahead and settle this, but can you report to the credit bureaus that it's paid in full? That's a whole different situation. And can you please provide me confirmation in writing once this is done?
And
Settlement, yes.
And they'll be able to do that? You've seen that happen before where they say?
Yes, I have seen it happen before, because at the end of the day, when the credit collection agency assumes ownership of that debt, the one thing that they're trying to do is they're paid for it already. They're trying to get the money. And of course, in most instances, when they assume ownership of the debt, in some instances, the original lender might say, hey, if you can get us 75% of what was owed, we're more than happy with it. Because at this point, it's charged off. I remember what we spoke about on the previous presentation. Once it goes through the charge-off process, it's off their books. So at this point, all they're doing is just basically trying to recover, what may have owed. So between the original lender and the credit agent, and the debt collection agencies, there's arrangements that are being made. So if they're going to give you a settlement offer to pay off something at a lower rate, that means essentially they've probably agreed to recoup 50% of that. Well, great. So they'll be able to satisfy the debt. That's kind of what the original lender would have, sold it to them for. But now you want to just make sure that it never shows settlement. That if you can avoid it saying settled on your credit report and just say to them, I'm willing to go ahead and accept your terms and conditions, but I need you to basically provide me confirmation that this will be listed as paid in full. Big difference. Because once it's paid in full, then on the credit reporting, on the credit bureaus, it's not counting to you as a negative.
And then how to relate from last week, you're talking about the time that it stays on your credit. So if it's paid in full, is it still the 7 years?
Well, essentially it could still be the 7 years. Great question, but you could request that it be removed and not be, and as if it never existed. There's a lot of different things that credit debt collection agencies won't tell you, because for them, it's just about getting their money. But essentially, if you say to them, hey, can you have this removed within and listed as if it never existed? So I'll pay it in full, great, but remove it from my credit report like it never existed. And at that point, it comes off. And then the 7-year period is not enforced. But if it's a settlement, it's always, anytime you working with debt collection agencies, settle the debt, but kind of figure out, kind of know your rights, because all they'll do is they'll just keep reporting it. They'll just report whatever they have to. They'll move on to the next person. But for you, it's like, hey, I'm going to pay this off in full, but can I ask that it be completely removed from my credit report? Like it never existed. And you'll find once that happens, that debt it may have been on the credit report for say 6 months. It falls off completely, never existed. Your score jumps up. Most people will see like a 20-point jump in their credit scores. Traditionally, I'm not saying that's a standard, but it's just like now you've paid, your income to debt ratios come down. Public reporting shows you don't have any debt collection outstanding on your credit report. If it's just current debts, even if you maybe 30 or 60 days, that's still going to basically positively impact the overall credit report. So yes, always kind of just, put yourself in a position to negotiate and get the best deal possible on the back end.
And then aside from that, the PSLF, and once it's discharged, how does that look in reporting to your credit?
It's a good question. I don't want to, I could possibly, follow up and look into it, because I'm not, I don't want to kind of give wrong information.
It's more new. Yeah, it's newer.
Yeah, it is. Yeah. So I'd have to kind of, let me just make a note of it, and maybe I can kind of come back with the answer next week. I'll kind of do some research on our end and just kind of see what that looks like, because I don't want to provide you with inaccurate information.
And just seeing how much it boosts your credit once.
Your credit, yeah, your credits. Because hey, the biggest, remember, if you looked at last week when we're talking about credit scores, like that payment on time and that utilization is 65%. Those are like the key things. So yeah, if those are, in at 30% and you're paying it on time, that will definitely help boost, especially if there's no collection agencies on there. Limit the number of collection agencies regardless of the amount, because as soon as they report it, it takes a hit on your credit report. As soon as that collection agency puts it on your credit report, in most instances, it's going to be a significant point reduction, so you can just always avoid having to get it. And if we do get that, just say to them, hey, I'm willing to settle it, but I need you to have it removed from my credit report like it never existed, and you get to go.
Thank you. And then the last final question is,
No problem.
you talked about debt versus credit card. I'm seeing a lot of articles, and for valid or I guess good reasons, where they're saying that you should not be paying as cash anymore. Like no one's using checks but cash. They said that you should use credit cards, obviously with the caveat that you pay it off at the end of the month. But do you want to speak to that? There are valid reasons, like you have more protections in terms of like if theft or warranties and things of that nature, and then I guess the rewards, right? Like if you have
Yes, yeah, I mean, most people will still. Most credit card companies. Most, credit cards now is, hey, essentially, of course, with cash, you always have to say to yourself, okay, when you think about it, the goal is to kind of build, kind of make sure you've got a good, healthy mix, of debt, and of course, your credit history is something that's kind of just, continuing to show growth. When you think about some of these credit card companies, they could be interest free. So, hey, we'll give you the debt. We won't charge you interest for 12 months, 18 months, 24 months. Great. Just pay us the standard amount. As long as you satisfy that, then you're not going to pay interest. So that's also a bit of a benefit. The rewards aspect is also kind of a benefit, but more people are kind of using, there is kind of this thing to where, hey, use debt, but just kind of use it responsibly. Because the one thing you always want to do is, like, if you've used a credit card and you spent $1,000 and the payment comes due and you drop that and you pay $700 off and you just keep that, about a $300 balance, that's still going to work in your favor. And then you can kind of, pay the remaining balance off in the second, and then kind of just making sure that your balances, your existing balances, just as long as they fall within that less than that 30% threshold, is going to work in your favor. So yeah, there is benefits. A lot of people are doing it. There's a lot of articles that are being written about it. I think it just comes down to where everyone is individually and what your ultimately what your financial situation looks like. And if you've got the cash on hand, I can tell you that, for the account that I support, we've had people come in, apply for the card, turn around, apply for the card, get the rewards back, turn around in 2 days and pay it off, right? And they're still going to get issued the rewards. It's still going to show that there was a credit, there was a charge to the card, and then of course the payment was just kind of thing. So most people are doing that. A lot of people are looking at ways to earn rewards, and if you've got the cash on hand, rewards, customers that come in paying cash are potential rewards customers. Customers that are coming in that don't have cash are potential financing customers. Those are people who are going to be looking at the interest-free over 12, 18, 24 months. And retailers know how to identify those customers. Hey, guess what? Hold on to your cash. Let's go ahead and apply for this. You get approved, great. I'll give you $100 back on this purchase.
Yeah.
And then just come back and pay it off.
And so, I said that was the last one, but it triggered another thought. Now with the advent of like Affirm, what is it, Klarna, and all of these things, are there more advantageous? I find myself using that more so because I'm not using the credit card, because then you can, spread it over a payment time and you're using actual cash, versus using a credit card. So
yes, I know. 4 easy payments, 5 easy payments, right? All these things. The only, yes, I'll be very honest. I think it's a Klarna's and all these different people that offer 4 easy payments. They're actually directly our competitors. So they actually essentially are competing with a Citibank, a Chase Bank, a Wells Fargo for that same customer, right? The only difference is, it's kind of, when you think about a credit card, I'm thinking about revolving credit. Yes, there may be interest rates that are going to kind of be charged, but essentially, if you can settle that debt in 90 days on your normal credit card, and maybe it's a credit card that's tied to an awards or, a rewards kind of thing, then that might be the good thing to go. Most, I'll be very honest, like the Klarnas and all these people, when you think about it, students, kind of college students and, people that, kind of, maybe just starting out, it's very, very attractive. It is, because I mean, like, it comes up as you're checking out, hey,
Yeah.
for easy payments of $35, and you're like, great, I'll go ahead and do this, right? But the only thing is, just satisfy the debt within the 30, make sure you make the payments on time, because if not, then you start to accrue, there's additional fees. There's always going to be, that the question that we have to ask, what happens afterwards? But yeah, those all those different payment plans that are being offered, they're direct competitors for the big banks. They are, because it's just making consumers, it's having consumers feel like, guess what? Hey, I've got 4 months to pay it off. And great, I'm gonna go ahead and take advantage of it. And people do it. I think it all just depends on what you're comfortable with. If your credit card balances are above 30%, and maybe you're hitting that 50% threshold, your debt to income ratios is definitely not looking favorable. So the best thing you can do is just always think, when you think about credit cards, always think about, what do I have to do to keep this below this 30% threshold? Because if you max out on a credit card, it's definitely going to have a large impact. So people look at that as an alternative. Great question.
Thank you.
If I could piggyback on Astrid's question, I have a friend who's not on the call today, so I'm gonna talk
Okay.
about her business a little bit. But she's been sucked into that trap with the Affirms and the Klarnas. And I have a couple of questions. First of all, how do those companies make money? Because they're not charging interest on those purchases. Are they being paid by the businesses? Because even
Yes.
though you may be
Yes.
approved for a certain amount of money, they're not
Yeah.
tacking on any additional
They're
interest
not.
to those purchase prices. And then, for her, she's been caught in the trap because it's coming out of her paycheck bi-weekly. It's not like she's making monthly payments, and she may have a credit limit on, Affirm in addition to the credit card she owns. So she's spreading, purchases across all of these different platforms. And, she's found herself kind of, in a corner.
Right. Yeah. And it's a pretty good question. Yes. If you go onto Amazon, if you go into any of these, major retailers out there, Amazon has a card through Synchrony, but some of these other major retailers, so yeah, they're basically negotiating for every card, for every person that applies and gets approved, there's a spiff that's paid to the retailer. They're making money. So the retailer will continue to do that. So if you think about it, and once you get into the cycle and 4 payments seems like it was easy, you come and you purchase it. So for every purchase that's made, depending on the purchase amount and how much the debt is, the retailer is making money on the back end. So essentially, with any bank that's working with a retailer, it's kind of what you call shared profit. It's shared profitability. It's what it comes down to. And, Macy's has a credit card, JCPenney has a credit card. At the end of the year, when you look at kind of whether it was interest-free or fees or anything else, the thing is, at some point, some people may fall prey to kind of having too many of these payments out there, but essentially they're not making, like they'll give it to you for 4 months and like, hey, go ahead, you settle it. But as long as you chose that option, there's a spiff that's being paid, and they'll keep, making it seem like it's affordable, to you. And if you notice, there's always minimum purchase amounts before you can qualify. In some instances, like, hey, you spend $100 and we'll get you finance for this. So yeah, but if you don't make those payments, and yeah, at the end of the day, all they worry about is just attaching a checking account to it and setting up auto pay. So if you can't make the payment, then it ends up working in their favor.
Okay.
Quick question. Thanks, Jermaine. This has been awesome. My name is Gwen. I have a credit card that I paid off, and
Correct.
I decided just not to use it. How
Okay.
long will the creditor keep it open if I decide not to use it for a bit?
In most instances, I think the standard timeline now is depending on the credit. I don't know who you have it with, but inactivity for 12 months could be as early as inactivity for 12 months from the last time you used the card So
Mhm.
from when the balance went to zero, completely zero,
Right.
inactivity could be 12 months or 12 to 18 months. So if you're
Oh.
not using it, I would always, when we think about the length of credit history, like I was saying, last week, don't close, if you don't have to close it off, don't close it off. I mean,
Yeah,
even if
I
you-
want to keep it so I can keep my ratios a little high,
Yes, yes. Yeah.
but at the
But-
same time, I should use it though, sounds like.
Yes, I mean, I would say at least,
But-
if the account is inactive, the general rule of thumb is about 12 months from the day the zero balance was accrued.
Oh, okay, and that, we don't want them to close it, because that's a
No.
problem, right?
Yeah.
Okay.
Yeah, you never
Okay.
want them to close it because it'll always, even if you closed it,
Mhm.
it just says on the credit report, it says close and it doesn't give you credit for closing it. It just says closed.
Mm. Oh, okay, and that's a negative, right?
That is a negative. That'll kind of, maybe
Yeah.
ding you 5 points, whatever the case might be, but it also
Okay.
depends on what that looks like.
Okay, so even if I just put $10 on it or whatever, 25, or whatever, just put something
25.
and pay it off.
Yeah, let it run, put $25 on it, get to the end of the month, pay, 60%, 70% of it next month. I mean, just keeping a limited
Keep it
balance.
active.
Yeah, just keep it active, but don't let it go dormant. Because if it
Okay.
does, yeah, they'll just take it upon themselves to close it.
Okay, thanks so much.
No problem.
Great class, appreciate it.
Thank you. And just to let you know, if they do close it, when you reapply, it'll be a credit check. It won't be like, oh, we just reopening your account. No, that's another credit check. So a lot of times I say, be careful because it could hit you twice. First, you get you get the reduction for the account being closed. And then you're like, what? let me go ahead and reapply just to have it open. That's another credit.
Mm.
So
Oh,
two times.
okay.
Yes, a follow-up to that, then now you lose out on that history. So if the credit card was
Right.
open for 20 years, right now it's reopened, it starts the time clock, is that fair to say, starts opening, ticking anew? It's
Yes.
like, oh, wow, yeah.
Oh,
Your length of your credit history is really, really important. So that first card, like you mentioned last week, that first card you opened, if you haven't closed it, you're doing very well because that will basically show active, in your account.
And also,
Yeah.
it's a good thing on another quick question. Another thing is a creditor decided to bump up my credit line. That's a kind of a good thing, right?
It is a good thing, but in most
I didn't ask
instances,
for it.
you didn't ask for it. So normally this is what they should be doing.
Mhm.
Send you an email notification advising you of a credit line increase,
Mm.
and then seeing if you want to opt for it. Because essentially, when they bump up your credit line, your income to debt ratio changes. And the higher your credit limit is versus your debt that you owe, that's
Mhm.
always going to be positive. But
Mhm.
creditors will generally bump up your credit line based on what they think your potential spending habits are.
Right, I noticed,
So
yeah.
if you're actively using the card and you're actively paying it off, they're like, you know what, you have 3,500, you deserve $5,000. And you're like, wow, great. Guess what? I've got an additional but there should be some sort of notification to you via email. And if you don't want the credit line increase, then it's a call and saying, I never requested this.
Mm.
Right.
Okay.
And then just making sure that they don't ding you for it. Because now that's something that could also happen.
Mm.
And if you have credit score monitoring set up, anytime there's changes on balances or credit limits, notifications will go out. And sometimes they'll even come back and say, hey, just to let you know, like a credit wise, we noticed that your credit limit was increased. Like credit monitoring is really, really good because that just kind of keeps you, informed of what's out there.
Right, but overall, if they increase your credit line, it should be good for you.
It is. It shows that you definitely are valued. You're not a high credit risk. People that are high credit risk do not get credit line increases. And if they're doing it every 6 to 12 months, it shows you have a very good payment history with them. And in addition to that, you're keeping that balance below that 30%.
Right.
When you become a risk to a creditor, they
They
don't
won't.
give
Right.
you. Yeah,
Thank you.
my pleasure.
I have a question around how much credit is too much credit?
That is kind of the magic question, right? And I have to kind of, be very honest. I think it all comes down to what your income, what your what your credit looks like in terms of your income to debt ratio. Because, you know, for people that are homeowners, think about those mortgages, those are large, you know, amounts. You know, for people that are not homeowners, if you're going to apply for a home, they'll ask you, what's your total gross income? And then they'll look at your debt. So I think it's always just kind of, and I always say, kind of keep that credit, you know, if you're making, I'm just going to throw a number out. If you're making about $100,000 a year, just a quick number out, and you're setting anywhere between $10,000 to $15,000 of credit, you know, debt, you're in a pretty good place. 20,000 might also be good, but once you start creeping into where your debt, where your debt obligation now is, you know, exceeding 20%, don't forget things like rent, utilities, and other bills still got to get paid. Plus, you got to pay those credit cards, right? Whatever that looks like. So if it's just, hey, I've got $15,000 credit limit, but I'm only at, you know, $2,000 to $3,000, you're in a good place. But guess what? My income to debt ratio only has me about, my total credit line is about 15% of my income to debt ratio, but my total credit that I'm using is less than 10%. You're in a good place. So I always say, just look at what your income is and just make sure you're not running up too much.
Okay, thank you for
credit-
that, because and the reason that I was asking is because I probably got about $50,000 spread across all the available credit across
Yeah.
all the credit cards, but I'm using between 1% and 3%.
Oh, you are in a very, very good place. 1% to
Okay.
3%. Wow. Okay. On a $50,000.
Yeah.
Okay, that's good.
So
Okay.
that's why I was asking how much is too much. Like,
Yeah, your credit, I mean, your credit lines can go up. The higher your credit line, the lower your credit usage, the higher your credit score.
oh, I like that. Thank you. I like that for me.
Repeat that statement you just said. I'm sorry. Thank you.
Higher credit line, higher
Mhm.
credit line, so available credit to use, lower credit utilization, higher credit score.
Gotcha. Oh, okay. Makes sense. Thank you.
Yes. Because you're not viewed as a risk. And as long as you're making those payments and you're making more than the payments, the minimum payments, then your payment history, your length of credit history, your credit mix, and your utilization, man, those are all the factors that are going to push your credit score. But if you had a $50,000 credit line and you've got about 22,000 on there, you're almost close to 50%. It's hurting you. It'll hurt you. So you just got to try to keep it as low as possible, so it doesn't negatively impact your credit scores. And if you had to go and apply, so even if somebody had a $50,000 credit line and they decide they want to go purchase a home, credit is going to look at like, wow, your potential is 50,000, but you're already at 40% of your debt on your existing credit line. Why would we give you an additional 500,000 here? You know, or if we do give it to you, we're going to give it to you at a higher interest rate so we can make money.
Right. On another quick subject, are we still able to pull our credit reports with a free credit report thing?
Yes,
Okay.
you're entitled to one free annual credit report a year, and you just got to go to freeannualcreditreport.com.
They was doing it once a month or more than that during
No,
COVID.
well, I mean, remember there were certain factors, like if you were unemployed, you were looking for a job, or you met certain requirements, you could pull it. But
Mhm.
essentially your free credit report, you know, is at least your free annual credit report from all three credit bureaus that will be sent to you is once, you know, within a 12-month period. But here's the thing, most credit card issuers right now, Capital One, Citibank, you know, or Chase, most of these major credit cards out there or credit card companies will give you the option to have, will give you the option to provide you with free credit monitoring. So that means you can just go in and sign up for it. In most instances, you know, it might be free for a year, right? Experian and some of these other places may charge you fees, like if you want to, you know, have access to it. But if you're talking about the full credit report, then yes, you know, once a year, or you can just sign up for it through the credit card company that you're already using.
Very good. Thank you. We're on a
Michael.
roll, or no, huh?
My
Speaking
pleasure.
of employers, what would they be pulling your credit for, even though you know that they do it? What are they looking for? I was always just curious for that.
Employers,
You know, when,
potential employers may pull
oh,
you.
yes, potential, sorry, yes.
Potential employers, in most instances, they're looking for anything that's public record. Especially if, depending on the role that you're going into, what does that look like? What is your standing overall? Because if there's any public records out there, public
What-
records means
yeah,
actions that have been taken against you, and
Okay.
it's now on your credit report, they have the right to know who they're employing. And
Yeah.
depending on the type of job that you're applying for, that could, be, essentially, so I'll give you an example. When I came to work for Citibank, they did an extensive report on me. So not only are they kind of checking for public records, they're also checking to see if there's anything else out there that could potentially be a red flag, just based on past or, current activities. Public record is what they're looking like. Are we employing somebody that is a, law-abiding citizen?
Mhm. Okay, thanks. for
And
the-
may I ask, is there a time limit on that public information? Although, like, also like medical debt, does it drop off after a period of time?
In some instances, it could be on there. Public information could be on there, for up to the 7 years as well, just depending on what pertains to it, what's involved, and what the circumstances were. It'll vary, yes.
I want to add something else to the employers checking. One of the things that came about as to additional information as to why they started checking them, they've had psychological studies of problem employees, and problem employees tend to also have poor credit. So they started allowing creditors, potential employers, to start viewing credit, which absolutely has a disparate negative impact on the Black community because of being shut out so many times. That's another way that, even though it seems on the surface that because they're doing the same thing for everyone that is fair, it's not. And they can use that to not hire you because you have a poor credit history, not just public records.
Public records, correct. Yeah, they'll look at almost anything. And if you're applying for a job where you may be required to handle money or some sort of financial, transactions within that company, and they think that there's a potential and you're a potential credit risk, they won't hire you. Because there's the thing about it, might be kind of thing to like, okay, this person already has some, financial challenges here. We're asking this person to manage funds in the business, or they're going to be transactioning on our behalf. Yeah, they could potentially deny you employment.
Absolutely.
But they
Jermaine, I
have
wanted
to, yeah, but they have to disclose why. They have to disclose why. So, if you're going to be denied employment, and they say, hey, based on your credit pool history that we did, oh my gosh, they need to be able to provide sufficient documentation. And hopefully, they've got all their ducks lined up, because if it is anything that's potentially incorrect and the decision was made, on their end, it could come back and definitely be a problem for them if you pursue legal action.
Yeah, they probably won't say that. They'll be using other things, but that's a factor that's helping them make a decision. Just like they also use people's social media to get a feel for who they're talking about. They're not going to tell you that we didn't hire you because of what we saw on your social media, but because then that opens the door as to having to prove it. I'm the former president of the NAACP. These are kind of things I've been fighting about. These things that keep us out of the job market, and it on the surface appears to be fair because you're doing the same thing so-called for everyone, but it has a disparate negative impact, discriminatory impact on our community.
Yes, and thank you for fighting. And I can also say, one thing that's, what's one of the ways that people try to connect out there now? Okay, you might talk about the social medias and the posts, but LinkedIn is another one. And in most instances, if you see people viewing your profile, people that you may have not known who are viewing your profile, But if you always, all of a sudden have a potential, maybe you've applied for a job, and all of a sudden you actually have somebody viewing your profile from that company. A lot of people go into your LinkedIn profile as well and kind of see, because a lot of people put a lot of information out there. Job history, qualifications, all these things. So, it's kind of designed to where there's so many, it's great to have the networking capabilities, and it's great to be able to kind of, have that in place. But I always say, what information are you willing to share with the public, and how much of it can, be potentially used either to your advantage or to your disadvantage. Like it's a very, very, thin line to kind of walk, because, comments, likes, feed, all those things kind of literally kind of, would make people kind of try to have them narrow down what kind of person you are. Who are you following? Who are you connected to? And what posts are those people putting out? Yeah, it's all very, and I guess it's, it's part of the web, right? The internet.
And a good point to note on that too for LinkedIn, that recruiters can be in incognito mode. And so you might not even know that they're looking at you on LinkedIn because they're in incognito. And so, yeah, so that's also.
Yeah, I always say, just kind of know what information is out there, but essentially, anything that I think is designed to be a disadvantage, based on a number of factors, that stuff needs to be called out, because everybody, I think, deserves a fair opportunity. But, it's kind of what's in place. So credit checks, employers, social, it's just kind of the way, I guess, life is now. So.
And then from last week, you did say, with the 7-year rule, if it's over a certain amount of money and the position, it still stays on.
Yep, they'll come in. Yeah, they'll
It
definitely
stays
come in.
on indefinitely. Is that correct? Like you
Yes.
said?
Yeah. They'll come in looking at, because hey, they're paying you 80,000, so 100,000. You might find yourself in a C-suite executive position. Reputation and everything else is at that point becomes a big thing. So, yeah. Thank you very much for all the questions, and I hope that I've been able to provide you with the suitable answers. And I will go back and look at what we'll actually just talk about the PSFL, so at least I can just kind of get some additional information, hopefully for next week's call.
Well, again, thank you so much. Sister Kimberly, did you have anything that you wanted to add before we end the session? Different opportunity. But thank you, everybody, for the questions. They were amazing.
So I just wanted to thank everyone for coming, and we appreciate you taking the time to be here. Thank you for all the really great questions, and we will see you next week.
Yes, and just to give you a heads up for next week, if I'm not mistaken, we'll be talking about identifying and avoiding scams. So that's going to be the next week session. Week 5 of what will be potentially 6 sessions. So we'll be coming to the end, I think, the following week. So it's definitely been a great opportunity to be able to volunteer and be part of this. So
when will the new episode, I'll call it, upload onto the site?
Tonight's episode?
No, next week's thing, because right now it only has week 4. So when will we
the participant guide?
Yes.
So I think there's no participant guide for next week. Is that correct?
That's correct.
Okay.
Thank you. Good night.
Thank you.
Thank you.
Have a good evening.